I just looked at Swiss 20-year rather, Swiss 20-year. I just looked at German 10-year, and it's a whole new world after all, isn't it? I mean, Draghi comes out, rates are low to begin with, and now their rates are ever lower as well. Could you please explain to me how negative interest rates benefits Europe?
Well, I mean, the impact is obviously differentiated. I know where you're going with that question. Look, the view is it's still, Europe needs monetary stimulus, and the negative rates are providing that, at least in those countries that are not net savers and where banks don't have excess reserves. Now, that leaves a couple where perhaps that's not the policy setting that they would like, but, you know, maybe in those countries you could take policy actions like fiscal policy to reduce domestic savings, which unfortunately we're not seeing. It's not all the certainly when you look at the German 10-year bonds, it's you know, as much related to German fiscal policy as to ECB policy.
Well said. What's the urgency here? I mean, we got through the zoo of 2 weeks ago, the zoo of last week. Maybe this week we'll get a big bank merger. Who knows? But what is the immediacy of where these rates are, or do we just slide into the summer of 2019?
I mean, look, there's been a growth slowdown, as I was saying earlier. If we do see a turnaround in Chinese growth, that will definitely lift Europe's growth prospects, and at that point, we would expect long-term rates to start rising again. But it's not going to be a V-shape rebound. The reality is, growth prospects are somewhat sluggish, and we could use some fiscal stimulus.
Give me a sense, Isabelle, of what you see for emerging markets. So this is the Fed story. This is basically going back to what Jay Powell said over the weekend. But this is also a set of idiosyncratic stories, such as Turkey, and today we found out it's in a recession.
Yes, so I mean, look, the global macro context is looking pretty good for emerging markets right now because we've got a very dovish Fed, a Fed that's on pause at least through the middle of the year, probably longer than that. That should keep the dollar fairly tame against EM currencies. And we've got China doing what it needs to do in terms of stimulus and likely to reaccelerate. So frankly, we like EM assets right now with a preference for EM equities, but even EM debt, there's lots of good things to say. We're not out of the woods in terms of idiosyncratic risk, but if you compare to last year, where we had some, like, you know, big game-changing elections in some of the largest economies, this year is looking much more manageable. Turkey is in a recession, not a big surprise. I mean, they had to go through a very large adjustment. They decided to do it without resorting to help from the IMF and the like. So, yes, not really a surprise. I think probably the worst is behind us. The economy is on the path of correction, but that doesn't mean that we don't like emerging markets right now. In fact, as I said, for the most part, we do like them.